In 1999, a company called Pets.com was worth nearly $400 million. 2 years later? It was worth nothing. The price was real. The value was a mirage. And most investors still can't tell the two apart. I've watched this confusion destroy more fortunes than any market crash. Good people. Smart people. Losing their savings because nobody taught them the one idea that Benjamin Graham built his entire philosophy on. Warren Buffett has said it 1,000 times, price is what you pay, value is what you get. It sounds simple. But today, I'm going to show you why almost everyone gets this wrong. And the third example I'll share? It's the one most investors get completely backwards. Here's the first trap. When you open your brokerage app, you see one number. The stock price. That's it. That's the number everyone talks about. CNBC talks about it. Your neighbor talks about it. Twitter won't shut up about it. But that number tells you almost nothing about whether the company is a good investment. Price is what the market is feeling today. Value is what the business is actually worth. They're related, but they're not the same thing. Graham had a beautiful way of explaining this. He called it Mr. Market. Imagine you own a business with a partner and every single day, this partner shouts a price at you. Some days he's euphoric and offers you millions. Other days he's depressed and begs you to sell for pennies. The business hasn't changed. Only his mood has. That partner is the stock market. Your job isn't to agree with him. Your job is to know what the business is worth and use his moods against him. Let me tell you about the year 2000. The Nasdaq had just hit 5,048 points. Investors were convinced the internet had rewritten the rules. Companies with no profits, sometimes no revenue, were trading at valuations in the billions. Pets.com, Webvan, eToys. These weren't businesses. They were stories wrapped in stock tickers. And the prices reflected the stories, not the numbers underneath. Then reality showed up. Within 2 years, the Nasdaq had lost roughly 78% of its value. Trillions of dollars vanished. And here's the part nobody mentions, the underlying businesses didn't suddenly become worse. Most of them were never worth what the market said they were. The price was a fantasy. The value was always zero. But here's where it gets really interesting. While the crowd was panicking in 2001, one company was being sold at fire sale prices, Amazon. Its stock collapsed by more than 90%. But the business underneath was still growing. Still investing. Still serving millions of customers. The patient investor who understood value got handed a gift by Mr. Market's depression. Now let's flip it around. 1988. Coca-Cola wasn't sexy. It was a mature company. Wall Street saw a slow-growing beverage stock. Flat headlines. No excitement. But Warren Buffett saw something else. He saw a business with one of the strongest brands on the planet. Pricing power. Global distribution. A moat so wide that competitors couldn't cross it. Buffett bought more than $1 billion worth of Coca-Cola stock, about $1.02 billion, to be exact. At the time, plenty of analysts called it a boring, expensive bet. Decades later? That position grew to be worth more than $25 billion. Plus billions more in dividends collected along the way. The price in 1988 wasn't cheap by traditional measures. But compared to the value of what Coca-Cola actually was, it was a bargain. That's the insight. Cheap prices don't mean value. Expensive prices don't mean no value. You have to look at the business, not the ticker. So how do you actually tell them apart? Here's the discipline. Ask 3 questions before you ever click buy. 1. What does this company actually do to make money? Not the story. The cash flow. Real customers paying real dollars. 2. What would I pay for the entire business if it wasn't publicly traded? Strip away the ticker. Strip away the news. If you owned it forever, what's it worth? 3. Is today's price below, at, or above that number? If the price is meaningfully below your estimate of value, you have what Graham called a margin of safety. That gap is your protection. Because you'll be wrong sometimes. Every investor is. The margin of safety is what keeps a mistake from becoming a disaster. If the price is above value, doesn't matter how exciting the story is. You walk away. This is the discipline that turned a kid from Omaha into one of the greatest investors in history. It's not a secret. It's not a hack. It's just paying attention to the right number. Graham said it best. In the short run, the market is a voting machine. Popularity. Emotion. Noise. In the long run, it's a weighing machine. The truth of the business eventually shows up in the stock. Price is loud. Value is quiet. Price screams at you every second the market is open. Value just sits there, patiently, waiting for you to notice. The investors who build real wealth? They stop listening to the screaming and start measuring the weight. Here's my question for you. What's one stock you bought because of the price and later realized you never actually understood the value? Be honest. Drop it in the comments. I read them. And if this shifted how you think about investing, hit that subscribe button. Tomorrow we're talking about the investor who beat the market for 50 years using one word that nobody uses anymore. You won't want to miss it. Remember, this is educational content, not financial advice. Do your own research. And invest in what you understand. Until tomorrow.